Welcome to episode 7 of the SaaS Report. I'm your host, Matt Aird, founder and CEO at Sales Science, and today we're going to be taking a look at Q2 numbers for Dropbox, Shopify, Zuora, and Uber. We're also going to be taking a look at some news that's come out recently from Stripe, showing that AI companies are growing much faster than their SaaS counterparts from 5 years ago. So we'll have a look at some of that data and the trends that uncovers. And then we'll also dive into this topic of slowing down to speed up in your go-to-market motion as an early stage tech company. But first, let's get into the numbers. So Dropbox released Q2 numbers. They're at 2.57 billion in ARR, but growth rates have really fallen off a cliff for them over the past few years. They've only had 2 quarters of double-digit ARR growth over the last 11, and in Q2 of this year grew at just 3%. As you'd expect, that creates kind of sales efficiency or go-to-market efficiency numbers that aren't too good. So they had a magic number of 0.12 and CAC payback of 122 months. But they're generating really healthy profits, right? So they're another example of a business that is recognizing that growth has slowed, and so they need to transition more to cash flow, operating income, net income production. And so net profit margins for Q2 were 17.4%, and they had 35% free cash flow margins for the quarter, so $224 million in free cash flow for Q2. Interestingly as well, they're at almost $1 million in ARR per employee. So the only other company that I've seen that's had a number that high is Microsoft. I think Microsoft is just over $1 million. These guys are just under $1 million. So crazy efficiency there in terms of ARR per headcount. And if we compare Dropbox to another company that we've looked at recently, Box, right? They play in a very similar space. You can kind of think of, Dropbox as the more SMB or consumer version of this document storage and management solution, and then Box plays kind of more in the mid-market and enterprise space. But they've seen very similar kind of results over the past couple of quarters, right? Slowing growth, much harder to generate, net new ARR, and so have transitioned the business into kind of more of a cash flowing or profit generating machine. And I think, the reason for this is just that you've got these 2 behemoths in Google and Microsoft that essentially bundling and giving away your core offer for free, right? If you're a small business or even if you're a consumer, you can typically get, file storage and document management for free with your email account, right? Whether you're running through Outlook or you're running through Gmail or Google. And that's really cannibalized this market that Dropbox and Box had generated a foothold in. So getting much harder for them to generate net new customers, but they're finding ways to transition that into profits and into cash flow. So not sure that there's a really clear path back to high growth for them, and that's kind of reflected in the valuation. So they're trading at 3.3 times ARR right now. So Shopify released Q2 numbers as well. They did over $2 billion in revenue in Q2. So that puts them at about an $8 billion run rate. That's up 21% year over year. And notice I said run rate there, not ARR. And the reason for that is that only 25% of Shopify's revenue is kind of like pure play software subscriptions, right? 75% of their revenue comes from this line that they call merchant solutions revenue. And basically what that is like their payment processing or the hardware that they provide to their customers in order to manage their stores, right? So if you're using Shopify checkout or Shopify payment processing, that revenue comes in at a much lower margin for Shopify because they need to pay things like credit card fees and fees to banks in order to make those transactions, right? So they're making less of each dollar that they generate through that service line. They keep fewer of them because they have to pay other parties in the delivery of that service. So that means their gross margin comes out at only 51%, right? So if you compare that to most of the other SaaS companies that we track, right, they've got gross margins kind of north of 80%. And so what that means for Shopify, obviously, is they've got much less to spend on OpEx, right? If more of that revenue is getting tied up in cost of goods sold or cost to serve, they've got less to spend on things like sales and marketing, R&D, and G&A. We can see that in the percentage of revenue they're allocating to those. So they only spend 17% of revenue on R&D and 17% of revenue on sales and marketing, right? Compare that to kind of the median of the companies that we tracked previously. Median on sales and marketing is around 40%. Median on R&D is kind of in the high 20s. And so they have to spend less to generate, profitability or break even. So they had operating income of $241 million for the quarter, or a 12% operating margin. Against the 30-odd SaaS companies that we track, that would put them in 5th place in terms of operating margin, right? So even though they've got a lower gross margin, because they're spending less, they've still got a relatively high operating income margin. So only Viva, Zoom, Palantir, and Salesforce have higher operating margins than them. They also generated $330 million in free cash flow. But interestingly for them, like ARR per employee is still very low, right? So they're only at 174,000, up from 143,000 this time last year. So still fairly inefficient in terms of ARR generated per employee. One of the reasons for that could be that Shopify has, from what I understand, a pretty large kind of customer service team, right? So they want to make sure that their merchants are successful, and they're employing a lot of people to make sure that that's the case, and that's kind of like bringing down both that ARR per employee number and then also, potentially that gross margin number as well. So Shopify, despite the lower gross margin, they're still trading at a pretty high multiple to revenue, so 13 times revenue run rate right now. Zuora also reported Q2 numbers. So I first came across Zuora a couple of years ago on LinkedIn. They had their pitch deck for, I think it must have been their Series A funding round. I was doing the rounds as like the perfect example of what a pitch deck should look like, right? I remember seeing Zuora, and they were painting this picture of, the future of business and the future of commerce, which is, everything moving to subscriptions, right? And they're going to be the platform that powers this new subscription economy. They went public in 2018 at about a $1.4 billion valuation, and hasn't really been smooth sailing for them since then, right? So market cap is down about 58% from their highs, and they've really struggled to grow ARR. So they grew ARR just 7% year over year in Q2. So that's sitting at just over $400 million right now. They added $8 million in ARR quarter over quarter and spent $36 million on sales and marketing in order to generate that. So that gives them a magic number of 0.23 and CAC payback of about 60 months. Over the last 12 months. They've got 104% net revenue retention, so decent, 7% free cash flow margins, and negative 8% operating margins. One of the interesting things about Zuora is that about 10% of the revenue that they generate per quarter comes from services, right? So professional services that are helping their customers to get the most out of the platform. And they run those services at a really big loss, right? So most companies that we look at, most SaaS companies, will have some element of services, especially kind of ones that are servicing larger mid-market or enterprise customers. And yes, these service lines typically run at a loss, but for Zuora, it's quite significant, right? So they generated $11 million in services revenue, and it cost them $14 million to deliver that in Q2. So a big hit to margins there. And yeah, they're just not in a really good spot, right? So struggled to grow ARR, not very good sales efficiency, pretty average gross margins. And so that means that they're trading at 3.2 times ARR right now. So next company I want to cover is a little bit different. So slightly outside the typical kind of, B2B SaaS company that we look at. But I want to take a closer look at Uber. And the reason for that is I think the story over the last few years is fascinating, right? So Uber is a company that's obviously so successful that their name has become a verb, right? But they've spent a shitload of money to get there. So between March of 2017 and June of 2023, Uber stacked up about $35 billion in cumulative losses. In the last 12 months, right, they've really turned this around. So they've generated $2.2 billion in net income in the last 12 months and $4.75 billion in free cash flow. They're growing revenue at 16%, and they generated almost $40 billion in gross merchandise value through the platform in just 90 days. Now, what that represents, that $40 billion, is basically everything that's transacted through the Uber platform, right? So it's like the total value of the rides, the total value of the Uber Eats purchases, that totaled $40 billion in Q2. Now, to put that number in perspective, that's about 25% of the total GDP of New Zealand. Right, so the amount of money transacting through the Uber platform alone is about a quarter of the entire economy of New Zealand. Now, one of the cool things about this story is that this turnaround that's taken place has happened under a professional manager, right? So this kind of goes against the meme that's circulating at the moment around this concept of founder mode, right? Dara Khosrowshahi, who came from a 12-year stint as the CEO at Expedia, he's been responsible for this turnaround at Uber, right? He took over in September of 2017, took Uber public in 2019, and has been responsible for this really, big change in direction. So since the IPO, the share price is up about 90%, and he's turned that around from, losses of about $1 billion a quarter when he took over to, as we've seen here, $2.2 billion in net income over the past 12 months. So to dive into the numbers, they have about 50% gross margins. They spend about 10% of revenue on sales and marketing and about 7% of revenue on R&D. They're valued at about $163 billion today, or about 4 times revenue. So into the main story for today, we got some news recently that Stripe has released some data around the growth rates of these AI companies. And what they did was they looked at numbers from this kind of current cohort of Gen AI and AI companies and compared that to a cohort of SaaS companies from 2018. And what the data shows is that this current crop of AI companies is growing at a much faster rate than this previous cohort of SaaS companies. So what we can see on this chart here is the median number of months that it took these businesses to reach different ARR milestones. So the median number of months that it takes these companies to get to $1 million in ARR, and when the clock starts is effectively when they bring on their first customer, right? So you could say any of the kind of product development, R&D stuff prior to going to market doesn't count. But once you get your first customer, the clock starts, right? For these AI companies, on average, it took them 11 months to get to $1 million. And for the 2018 SaaS cohort, that was 15 months. We can also see up to the $5 million revenue mark that the AI companies kind of accelerate even further, right? So it takes them about 23, 24 months to get to that $5 million mark versus 33, 34 months for these SaaS companies, right? So clearly in that early phase, right, they're growing ARR at a much faster rate. Now, there was another cohort of companies that they looked at that had been even more successful. And when we expand out the ARR run rates, we can see again that these AI companies are getting to these milestones much faster. Right, so in this chart here, what we can see is that the median number of months that it took one of these AI companies to get to $30 million, so for those that did get to 30 million in ARR, they did it at a median of 20 months. For the SaaS companies, it was more like 65 months. Right, so it's about 3 times faster, right? These companies are growing ARR, even scaling it to pretty large numbers at $30 million, they're getting there about 3 times faster than that SaaS cohort did in 2018. One of the factors that's influencing this in the article that they point to is the fact that these AI companies are attracting international revenue at a much faster rate than the SaaS cohorts from 2018. So what we can see in this chart is that in the first year, these AI companies are generating about 56% of their revenue from overseas buyers. Compare that to just 36% of revenue from the SaaS companies. That does tend to balance out over time, but even in the 4th year, right, these AI companies are still generating 50% of their revenue from overseas, and the SaaS companies are generating 40%. So by going international more quickly, this is something that we saw with a company like HubSpot as well, is that by broadening the customer base and figuring out how to sell internationally sooner in the company's life, you give yourself the ability to be able to grow ARR faster because you can tap more of your ideal buyers in different markets, right? You don't saturate your markets locally as quickly if you're able to operate in multiple geographies. Now, one of the counterpoints to this growth story is it's not like comparing these companies as apples to apples because these AI companies don't have the same margin profile as the SaaS businesses. They're typically much more capital intensive. They require kind of higher levels of spend in order to deliver services to customers based on the amount of compute that they're utilizing internally in order to deliver that outcome that the customer wants. And the way that we can have a look at this data and prove that out is that there's actually a public kind of AI company that follows a very similar trend to the companies that are spinning up at the moment. This is a company called C3.ai. So C3.ai is a company that's been set up that helps mid-market and enterprise companies to deploy AI internally. So they fine-tune, publicly available models, and they help these organizations to build workflows in order to leverage AI internally across their documents and their data sets. Now, what we can see when we look at C3.ai's numbers is that they're only generating about a 60% gross margin. Right? We compare that with the 80% plus, and in some cases 90% gross margins that the SaaS companies generate. Right? So if you think of like Asana or Monday.com, right? These companies are generating 90% gross margins on revenue. By spending 40% on cost of goods sold or cost to serve, that means that there's less money available for R&D and G&A and S&M, right? And so C3AI, they spend about 60% of revenue on R&D, they spend another 60% on sales and marketing, and they spend 23% on G&A. So that sounds pretty similar, right, to a high growth SaaS company. The problem is when they're spending at those rates, they're generating a negative 82% operating margin, right? Because more of that money is being tied up in cost to serve. If they try to spend at the same rates that SaaS companies do on things like R&D and S&M, right, what ends up happening is they just burn way more cash. And so the question becomes like, how do these companies get to profitability? You know, if they're spending so much on cost to serve, then the OpEx profile is going to have to look a lot different, right? Even OpenAI, who is kind of the golden child in this space, they're at about a $3.6 billion run rate, and they've burnt about $5 billion per year in order to get there. They're obviously in a little bit of a different scenario. They're kind of building the LLM, right? So they're kind of doing the groundbreaking work. But the question remains is like, how much or for how long is that work going to have to continue? And then how do you realize kind of the economic value or the benefit on the other side, right? If we look at, or if we compare that to kind of like a pure play SaaS business, right? We could look at Salesforce back in 2005, right? In 2005, Salesforce was generating 80% gross margins. They were at about 300 million in ARR as well. They were spending, only 7.5% on R&D, 50% on sales and marketing, and 16% on G&A, right? And they were generating positive operating income through that period. And so the question here is just like, how much money is going to be available for these AI companies in order to continue scaling this growth, right? And then how do they turn that revenue into operating income and margin? I think the same argument could have been made for a lot of these SaaS companies over time, and we've seen that they've been able to make the transition. But one of the reasons that they've been able to do that is because of the very strong gross margin profile, right? If you're playing with 20 or 30 percentage points less of gross margin, it may make it harder to actually turn all of this revenue into, free cash flow or operating income at some point in the future, right? So the growth is good, right? The fast growth in this AI space is good. It's great for these companies. It's good for the ecosystem. But yeah, we just need to, I think, take into account the fact that these aren't SaaS companies, right? They don't operate at the same margin profile. And so it's going to be really interesting to see how this market segment evolves over the next few years. One of my favorite concepts to think about in go-to-market for early stage tech companies is this concept of slowing down to speed up, right? So if you're running an early stage SaaS business or you're an employee there, you probably feel pressure every day to just get stuff done, right? Ship, get things out, run experiments, test, right? Just do work because you need to keep moving the ball down the field every single day. One of the situations though, I would kind of like urge some caution or some pushback here is in one of the core kind of go-to-market functions, which is thinking about and mapping your market, right? Really trying to understand who you can help today be better with the solution that you have, right? So this is the idea of like your ideal customer profile. And as a scrappy kind of startup, you really need to make sure that all of your efforts are focused as much as possible on the accounts that you can help the most. Because any time that you spend, prospecting to or marketing to companies that sit outside that sweet spot is time that's wasted, right? You've got limited resources. There are so many hours in the day. There are so many marketing campaigns that you can run. There are so many cold calls that you can make. And so what you need to do is make sure that as much of that effort as possible is directed at companies that are the right fit, right? And this can be a little bit painful and tedious, right? But what I would urge you to do is to get 200, 300, 400 sweet spot companies and map them completely, right? And by that, I mean, get them in your CRM, find all of the key stakeholders at those companies, right? Get them in the CRM and then get them fully enriched. And make that the kind of the core go-to-market effort is to have as many conversations with people in the sweet spot as possible. Now, what you don't want to do here is just rip out a database. So you don't want to go to like ZoomInfo or LinkedIn Sales Nav, type in some really high-level filters, export that and chuck it into the CRM. You want to go through these companies and these accounts, one by one, line by line, to make sure that they fit that profile or that hypothesis that you've come up with, right? Because as an early stage company, if you can have, conversations with 20, 30, 40 of these, best fit companies per month, that's really going to help to inform not just, kind of go-to-market messaging and approach, but also kind of product roadmap as well. Now, ideally, this isn't work that's done by, an SDR or a salesperson or a junior marketer. This should be work that's done at the highest levels in the company, right? Because when you're really trying to figure out who you can help and who you can't, you really need that senior level input into that mapping process. The good thing about this is that if you have a hypothesis and it gets proved out, right, you really need to do this exercise once. It's like, find these companies, let's get them mapped, let's get them in the CRM, and then let's track kind of account penetration and conversations with these accounts over time. Now, if you find out that they're not a fit and you need to make adjustments to that ICP description, then go and do that, and then go and do the work of finding them again. But the idea here is that that tier 1 or tier A accounts, as people call them, right, needs to be really clearly defined, and you need to have a strategy for trying to approach and penetrate each one of those early on. It's just going to make everything a lot clearer from a go-to-market standpoint if you have that crystallized and everyone in the company is on the same page around what a good fit company looks like. And more than that is that we actually already have them mapped, right? We know who we're going after. We know who we want to speak with. We know who we're trying to convert into customers. To try to give you a real world example of this, we work with a company called AuthSignal, right? And what AuthSignal do is they sell authentication software. So basically they help companies to make sure that, the people logging into their apps or their systems are who they say they are, right? Now, what AuthSignal has done is that they've gone out and mapped the market in all of their key geographies, so APAC primarily. And what they've done is they've identified all of the B2C companies that operate at some level of scale, right? And so we've defined what that looks like. What does scale mean to them? And then we've gone and scraped all of the organizations that exist within those industries, right? Now, the tricky thing about that scrape is that if you're using a tool like LinkedIn Sales Navigator or ZoomInfo, you can't simply define, businesses that have, consumers as their primary customers, right? There isn't like a B2C function that you can use to scrape where you get a perfect list. So what you kind of have to do is go industry by industry, pull the relevant companies out, and then you need to run a second kind of degree of filtering to understand, is this primarily targeting B2C? And do they have some kind of app or login functionality available, right? Because AuthSignal isn't helpful to anyone if there isn't a login process involved. And so what AuthSignal has done is they've gone and looked at, okay, does this fit into one of our target industries? Does this fit into one of our target geographies? Do they meet our scale requirements, right? Do they primarily serve consumers? And do they have a login workflow as a part of the process of serving those customers, right? And only when a company ticks all of those boxes do they become a target account, right? So that's the level of granularity that you kind of need to develop in order to make sure that your effort and your attention from a marketing and a go-to-market standpoint is focused on the right accounts. If you're doing it in a less granular way than that, then you're likely wasting time, right? And this has a real cost. If you've got an SDR that's executing outbound for you, and let's just call it, 10% of the target accounts that they're reaching out to you can't buy for whatever reason because they're a bad fit, and then another 10% are unlikely to buy because they don't tick a particular box, right? That means that 20% of the cost of that person is completely wasted, right? You're spending 20% of the cost of that person on something that's going to generate no revenue for the business, right? And worse than that, that 20% of time that you're not spending chasing good fit customers means that you're not speaking to more good fit customers, right? So that could have a 20% impact on revenue growth, on ARR growth in the company because that person is misdirected around who they're reaching out to, right? So this is really one of those examples in a SaaS startup where slowing down to speed up makes a real difference, right? So I urge you to figure that out. Figure out what are the 5 or 6 key things that these accounts need for them to be a good fit customer for us, and then go and find everyone that fits that profile so that you can start reaching out to them. That's it for this week. Just a reminder, if you haven't grabbed the Q2 SaaS metrics report yet, go and do that. We'll drop a link to the show notes. I was also on the Revenue Mechanics podcast this week. That'll be live by the time you see this. If you haven't checked out that episode with Sam yet, go and do that as well. I'll drop a link here in the show notes. We had a really good conversation about the trends in the go-to-market environment, particularly around outbound, and the impact, good, bad, or indifferent, that AI might have on that over the next couple of years. So if that's interesting to you, go and check out that podcast. I really enjoyed that conversation with Sam. But that's it for today. Thanks for joining me. Again, if you have any feedback, let me know. I want to make this as interesting and informative for you as possible. I'll see you next week. Until then, goodbye.